Welcome to this short tutorial on Chapter 16, Section 85 rollovers. This tutorial is going to look specifically at the adjusted cost base and determining the paid up capital of the shares that are transferred in a Section 85 rollover. Moving on to the next slide, take a minute and read through this example. So pause the video here, read through the example. Once you've read through the example, then resume the video. So pause the video now. Okay, let's take a look at this example. We're transferring a non-depreciable asset that has a book value of $620,000, and the transferor is going to receive a combination of boot and also shares. Now, the total consideration is $814,000, and that consists of two types of shares: preferred shares and common shares, which have a total market value of $489,000, and also boot, which is new debt and also the assumption of old debt. So the total non-share or boot consideration is $325,000. Now the transfer is made at the elected value of $620,000, which is the minimum amount that could be transferred at. So let's move on to the next slide and look at the tax consequences. Well, there's no gain. The transfer was at $620,000, so that's going to be the proceeds of disposition. The adjusted cost base is also $620,000, so there's no gain on the transfer. And once again, that's primarily the objective of a Section 85 rollover, is to minimize any tax consequences. Now, when it comes to determining the adjusted cost base of the shares held by the transferor, there's a three-step process. First, the elected amount, or the elected value, the transfer amount, is allocated to the boot first. Once that is done, any leftover amount will then be allocated to the preferred shares based on the fair market value of the consideration received, and then any residual will be allocated to the adjusted cost base of the common shares. So let's see what we have here. The elected value was $620,000. The boot, or the non-share consideration, was $325,000. So those two debt amounts will get a total of $325,000 allocated to their cost or value. And the residual amount of $295,000 will first be allocated to the preferred shares based on the fair market value of $225,000. And then any residual amount, which in this case is $70,000, will be allocated to the common shares. So that's how the adjusted cost base will be determined. The total adjusted cost base of both the preferred and common shares will be $295,000. Moving on to the next slide, let's talk about what PUC is. Now, we learned from an earlier chapter that PUC, or the paid up capital, is a different concept from adjusted cost base. PUC is the legal stated capital. Stated alternatively, we could say PUC is the fair market value of the consideration that was given up for the shares. So essentially, it's going to be the fair market value is the starting point for PUC. So the starting point for PUC then is going to be the fair market value. Now, the fair market value of the preferred shares plus the common shares is $489,000. Now, the concept of PUC is that that's the amount that could be returned tax-free. Now, if the preferred shares and common shares were sold for the current fair market value of $489,000 minus the ACB of $295,000, there should be a capital gain of $194,000. Once again, 50% of that would be taxable. However, the concept of PUC says that if the PUC stays at $489,000, that's the amount that could be removed tax-free, escaping any tax liability. So for example, if the company was to repurchase the shares from the shareholder, the PUC amount, which would be $489,000, could be returned tax-free to the shareholder. Now, that would not be fair, so there needs to be what we call a PUC reduction. So moving on to the next slide, let's just summarize what we know. The adjusted cost base of the preferred and common share is $295,000. The PUC before the reduction is the fair market value of the preferred and common shares, which is $489,000. Now the formula for the PUC reduction is A minus B times C over A. So what are these components? A is the increase in legal stated capital of all the shares. That's the PUC amount before the reduction. B is the elected amount, or the transfer value, minus the boot. So A minus B would be the PUC reduction. Now C is the fair market value of a particular class of shares. So the ratio of C over A, that would only apply if there was more than one type of share that was issued in the Section 85 rollover. If there was only one class of share issued, then all we would need to worry about is A minus B. The C over A is just the proration based on different types of shares that was issued in the Section 85 rollover. So once again, A minus B would be the total PUC reduction for all the shares. In our example, A, the legal stated capital, or the fair market value of the shares, was $489,000. B is the elected amount minus the boot, which is $295,000. So the PUC reduction is going to be $194,000. So let's keep those values in mind, and then we'll move over to the next slide. In the next slide, let's look at the specific formula then. A minus B, $194,000. The C over A, once again, that's going to allocate the PUC reduction to the different types of shares that were issued in the Section 85 rollover. Now, in our example, we had preferred shares. So let's look at the preferred shares first. The PUC of the preferred shares before the reduction was $225,000. That was the fair market value. Now we have to minus the PUC reduction. A minus B is $194,000 times C over A. Now C is the fair market value of the preferred shares, which is $225,000, divided by A, which is the total legal stated capital of both the preferred and common shares. That's that ratio, that's the proration of how much of the PUC reduction we're going to allocate to the preferred shares. So if you work through the calculation, the legal stated capital of the preferred shares, $225,000 minus the reduction. The PUC of the preferred shares will be $135,736. Now for the common shares, we work through it the same way. The legal stated capital of the common shares is $264,000 minus the PUC reduction. Now the PUC reduction is the total PUC reduction of $194,000 times the ratio of the common shares fair market value, $264,000, divided by the total fair market value of $489,000. And so the resulting PUC for the common shares will be $159,264. Now if we add those two together, the total PUC is $295,000. Now this equals the total ACB. So what this says is that if, let's say, the shareholder was to sell the shares back to the corporation was to buy the shares back from the shareholder, the total PUC of $295,000, that would equal the ACB. So the shareholder could not escape taxation if they were to dispose of the shares back to the corporation, because the PUC is equal to the ACB. So that's an example of how to determine the ACB and the PUC in a Section 85 rollover. Let's move on to the next slide, and now we're going to look at a specific example in your textbook, assignment problem 16-2. So find assignment problem 16-2 in your textbook. Read case 1 only. We're just going to do case 1 first. But for case 1, do parts A, B, and C. Now part A, you have to determine what the minimum and maximum transfer price could be. That's the floor and the ceiling. And then part B, we're going to assume that we're going to elect the minimum floor value for the transfer. We're going to determine any tax consequences. And then in part C, we're going to determine, once again, using the minimum transfer price, what is the ACB and PUC of the shares. So pause the video now, and when you're ready to look at case 1, part A, B, and C, then resume the video. Okay, let's have a look at the solution. Now, case 1, we're looking at depreciable assets. And part A, we need to determine the maximum and minimum values. Now, the maximum transfer value, the upper limit, is going to be the fair market value of the assets, which in this example is $183,400. Now, the floor, or the lower limit or minimum, is the greater of two amounts. The first amount is the boot or the non-share consideration, which is $140,000, and the second component is the lesser of three amounts. Now remember, for depreciable assets, it's the lesser of the UCC, the cost, or the fair market value. Now, when looking at all those three amounts, the lesser amount is the UCC of $59,904. However, the floor, or the lower limit, is the greater of the boot and the UCC. So in this example, I've highlighted that the floor is going to be $140,000. So the range for the transfer value, or the elected amount, needs to be between $140,000 and $183,400. Now, part B says that we're going to assume that the minimum elected value, which is $140,000, is selected. And so what are the tax consequences? Well, whenever there's a disposition of depreciable assets, we have to subtract the lower of cost or proceeds from the CCA class. And that's going to result in recapture of $70,096. Now that $70,096 is going to be an addition to the transferor's income. In addition to that, there's going to be a taxable capital gain. The deemed proceeds are going to be $140,000 minus the cost of $130,000. There's going to be a capital gain of $10,000, which 50% will be taxable. So that results in a taxable capital gain of $5,000. So that is part B. Moving on to part C, now we have to determine the ACB and PUC of the preferred and common shares. Now, earlier on in this online tutorial, we said that the ACB, we have to basically take the elected value minus the boot, and that's going to be the amount that would be allocated to the ACB of the preferred and common shares. Now, we have 0 here. So even though we're supposed to allocate the residual to the preferred shares first and then the common shares, because we have 0, we know then that the ACB of the preferred and common shares will both be 0. Moving on to the PUC, we start off with the legal stated capital, or the fair market value. In this case, the fair market value of the preferred shares is $22,000 and the common shares is $21,400. So the total legal stated capital before the reduction is $43,400. Now we have to look at the PUC reduction. A, $43,400 minus B, the elected amount minus the boot, which is 0. So the PUC reduction, A minus B, needs to be $43,300. If the legal stated capital of all the shares is $43,400, and we have to reduce that by $43,000, that should say $43,400, by the way, not $43,300. The PUC reduction of $43,400 will result in a PUC equal to 0. So once again, there's a typo there. The A minus B should be $43,400, not $43,300 as listed. So that we know then that the PUC for both the preferred and common shares is going to be 0. Now, in this case, we don't have to worry about the C minus A ratio because we know that the PUC overall is going to be 0. So we don't have to worry about that calculation in this specific example because the total PUC for both the preferred and common shares will be 0 anyway. So that's case number 1. Let's now move on to case number 2. So read case number 2, do parts A, B, and C, and then resume the video. So pause the video now, complete case 2, parts A, B, C, and then resume the video. Okay, let's take a look at the solution for case number 2. Case number 2 involves inventories. Part A, we're going to determine the maximum and also the minimum transfer price. Now the maximum is the upper limit or the ceiling, and that's going to be the fair market value of the inventory, which is $120,000. Now the lower limit or the floor is going to be the greater of two amounts. The boot, the non-share consideration, $93,000. Now for inventories, the second component is the lesser of two amounts, the cost and the fair market value. Now the lesser of those two amounts is the cost of $87,000, but the floor is the greater of the boot and the cost. So the greater of those two amounts will be the boot. So the highlighted amounts is the range. A lower limit of $93,000 and an upper limit of $120,000. Now in Part B, we're asked to determine the tax consequences if we elect the minimum value of $93,000. Now, if we elect the minimum value of $93,000, the $93,000 is going to be what we receive, the deemed amount of what we receive from the disposition of the inventories. Now, when we're selling or transferring inventory, that's deemed to be business income, not a capital gain. Inventory is purchased and resold in the course of the day-to-day activities of a company. So this will be determined to be business income. So the $93,000 minus the cost of $87,000, this transferor will have to include business income of $6,000 in their income. So that's going to be the tax consequences for Part B. Let's move on to the next slide and look at Part C. Let's determine what the ACB is first. Now, once again, we start off with the elected value of $93,000. We minus the boot, which is $93,000. So the residual amount is 0. And so we have nothing to assign to the ACB of the common shares. So the ACB will be 0. Now, with respect to the PUC, we start off with the legal stated capital, which is the fair market value of the common shares, which is $27,000. Then we have to figure out what is the PUC reduction. Well, the PUC reduction is A, which is $27,000, minus B, which is 0. So the PUC reduction is going to be $27,000. Now, once again, we don't have to worry about the C over A because we only have one type of share. So the total PUC reduction is going to be $27,000. So the PUC then for the common shares will be 0. The original legal stated capital of $27,000 minus the PUC reduction will result in 0 PUC for the common shares. And once again, this equals the ACB of the common shares. So that sort of all makes sense. You cannot escape any accrued gain on the sale of the common shares. So let's now move on to case number 3. So once again, read case number 3, do parts A, B, and C. So pause the video now, and once you're ready to check your solution, then resume the video. Okay, let's take a look at case 3. Now in case 3, this is a transfer of land. The maximum or the upper limit ceiling is going to be the fair market value of the land, which is $823,000. The lower limit or the floor is going to be the greater of two amounts. Now the greater of one, the boot, the non-share consideration, which is $72,000, and the second amount is the lesser of cost and fair market value. Now the lesser of those two amounts is going to be the cost of $617, but the lower limit is the greater of boot and the cost. So the greater amount is going to be the cost, which is highlighted. So the range for the transfer value needs to be between $617,000 and $823,000. So Part B, we're going to assume that the minimum amount of $617 is the elected value. So what are the tax consequences? Well, there's no gain because the proceeds for the sale or disposition of the land is going to be $617 minus the cost of $617 will result in a 0 gain. So there's going to be no gain on the transfer of the land. Moving on to the next slide, let's look at Part C now. the ACB and PUC of the common shares. Once again, the total elected value is the starting point, and from that we assign the boot the value of 72,000. So the residual amount is going to be 545,000, and that's going to be the ACB of the common shares. Now, what about the PUC? Starting point for the PUC is the legal stated capital, which is the fair market value of the common shares, is 751,000. Now we have to figure out what's going to be the PUC reduction. Well, the A amount is the legal stated capital, 751,000. The B amount is the elected amount minus the boot, 545,000. So the PUC reduction then, the A minus B, needs to be 206,000. Now once again, we don't have to worry about the C over A because we only have one type of share in the transfer, which is common shares. So the PUC then will be the 751,000 minus the 206,000 PUC reduction. So the PUC for the common shares is going to be 545,000. And once again, this makes sense because this is also the same amount as the ACB of the common shares above. So that brings us to the end of this tutorial on how to determine the ACB and PUC on the Section 85 rollover.